this paperless budget into 10 paper, not in the 1 lakh papers.
Yeah.
Sir, we can start now.
Yeah, thank you. Thank you. So now whatever we talked informally, fine. Thank you very much. Thank you very much. We are today here to discuss implications of budget 2022 and 23. We have learned speakers, Mr. Firoze Andhyarujina. Everybody knows him. He's a senior counsel in Supreme Court. Mr. Chakravarti is a partner with Shardul, Amarchand, Mangaldas and Company. We have Madam Anubhuti Sahay, the head of Asia Economic Research, Global Standard Chartered Bank. And friends, budget, you know, there was another opportunity after 2 years of COVID that we could have come out with a more bold budget than what we have given. No doubt, this budget, some people call it a balanced budget. Some say the government has been able to give no surprises, such as no new taxes in any form. And various other areas have been kept intact as they were. I mean, whatever concessions are there, they are continuing. Nothing has been withdrawn and no new concession have been added. That's one fine. But two areas which have been left out is, the one is women entrepreneurship. Some incentives should have been given for women empowerment. If as government has been talking so much about women empowerment, and the farmers, because we had one long year of farmer agitation, and government could have looked at some issues of farmer incentivizing. Because during COVID time, fortunately, we were the only country which had no issue on food front. And our agriculture exports have doubled than the pre-COVID area. This is the only area, pharma, IT and food products which have exports have gone up in last 2 years. Rest, of course, you know, the things were bad on either side, whether it is Europe or whether USA or Africa. So things didn't work out. So we could have done something more to incentivize the farmers, that those who go in other rural areas and extreme rural areas to develop farming, some government incentive or some mechanism by which government machinery deployment or some area could have been thought of. We have predicted 9.2% economic growth, and I think 9.2% is a good number. But looking at the pre-COVID, they have taken 20% as the basic. That in the COVID, what we lost, so the 20% gain will be always there. But looking at the buoyancy in taxation, 90% corporate tax have gone up, 90, and GST collection have gone up. Like January itself was 1 crore 41 lakh crores, which is a big thing, 141, and that's a very high number. Looking at the COVID, and we are looking at the working hours curtailed, we look at the consumption still not picking up, whether it is in automobile sector or some other sectors. When the consumption, if once that would have picked up, it would have been 160 or 170 crore, 1.60 or 1.70. So that would have been another area. The custom tariff, of course, on the steel, they have kept 1%, which is good because the scrap, because the demand of the steel has been going up and government had looked at that very seriously. MSME, except the ECLGS scheme, which they extended by 1 more year. We had demanded for 2 years, but they extended by 1 year. That's fine. But nothing much beyond that has been done for MSME, where we could have looked at little more. Of course, the government is going to have various free trade agreements signed in the coming year with European, with Canada, and with other UK and other Australia and other countries. And we hope such areas of working would be much acceptable to the people. I thought that GST, they could have come out with some incentive in in the sense that except the alcohol and automobile, and the tobacco, the 28% should have gone away on all other items. The 18 and 12%, even that is on a higher side, but we could have worked with that. And because when you have excess taxation or high number of taxes when you impose, there is always room for unfair practices, and which happens. You can't skip out of it. But the new SEZ legislation is coming up. Instead of that, they could have accepted the Baba Kalyani committee report and would have gone as it is on that SEZ. Because the SEZ has been not taking up. Smart cities, there has been no talk about smart cities. Because they had earlier announced 100 smart cities, but in the budget, there's nothing. Except that 7.5 lakh crore which they are going to spend on infrastructure, from 5 lakh to 7.5 with the increase. That will give a big boost to the economy and connectivity, as well as whether it is railway, road, or either way. Because 25,000 crore alone they will spend on highways, besides 2,000 kilometers of railway line which they propose to set up. So I feel that overall the market has received it well, because the long-term capital gain with 30% have come to surcharge, which has been reduced to 15%. So about 4.5% of tax relief is automatic, directly received by a taxpayer. But the individual tax paying, they could have looked at it. They could have increased in view of the inflation that the slab for the individual taxpayers, which could have been, as per indexing also, they would have taken, they could have done it by 25% minimum slab could have been increased. And they could have given some relief so that the common man could have saved. Because today middle class is one class which is being paying the heaviest taxes, whether it is GST, whether it is income tax, whether anything. That middle class has been compressed. I don't know. The BJP government's main vote bank is middle class, and they are ignoring it. I don't know what's up to their sleeves, but anyhow, the digital cryptocurrency has been recognized. In fact, whether you call it a digital rupee to come and then you make it 30% tax, now the tax can be today more or less. And India is one of the biggest receiver of the digital economy. And cryptocurrency, the number of people in India who have invested are quite huge. So one way government has said, let us regularize and take 30% tax rather than you raiding people. That's a good way of doing it. So I hope overall things pick up, and if some things have been left out, government can reconsider during the discussion on budget, and some suggestion could be looked into. But I saw that various suggestions made by various industry, agriculture, labor union, and others, none of the suggestions reflect in the budget. Because I have read the suggestions of most of these sectors, industry sector also, who went to meet FM, agriculture sector, labor, and others, but none of them have been reflected in the budget. Hope in times to come they look at those suggestions seriously. With these words, I conclude my opening remarks and thank you, my learned speakers, for being with us this afternoon. And hope we learn from you how you perceive the budget. We start with Madam Anubhuti Sahay, the Economic Research and Global Research Head of Standard Chartered Bank. Please, Madam Sahay.
Thanks, Dr. Vijay, and very good afternoon, good evening to all of you. Thanks for taking time out for this discussion. So as Dr. Vijay highlighted, I am an economist. So I will focus on the implications of the union budget on GDP growth, interest rates, because I understand the audience is interested in understanding the implications of union budget on interest rates, and equally importantly, on rupee. Where is rupee going? Because we all get impacted by rupee movements. But before I delve into the implications of union budget, I think we need to look at the union budget in amid the broader global and domestic backdrop. If you look at the economic environment today, and I would divide the broader backdrop in two parts. To start off with, after the big shock which the global economy, including India, received in 2020 on the outbreak of COVID-19, we have consistently seen economies recovering. The recovery process is still ongoing, and there are quite a bit of divergent trends. Few economies, especially in the developed markets, if you talk about US, Europe, they have been able to recover at a much faster pace vis-a-vis some Asian economies or Latin economies where the fiscal stimulus has been much smaller, or where the vaccination coverage has not been as good as the developed markets. Similar divergence also exists when it comes between larger companies, organized sector versus smaller, medium companies and unorganized sector. Hence, even though the recovery process has been ongoing over last 1.5 years, it remains uneven and incomplete. And policymakers, including laymen like us, we completely acknowledge that some part of the demand has been permanently lost, and that is getting reflected in higher levels of unemployment, lower labor force participation, and lower income and increased inequality. These aspects will have to be kept in mind by policymakers, whether they are government or central banks, when they are modulating policies for not only for next 12 months, but probably for next 3 to 4 years. The second part is, as I mentioned, the recovery process is ongoing, but it remains uneven and incomplete. But it is equally true, and we need to keep that in mind, that we are no more in the emergency period the way we were in the calendar year of 2022. We have exited the emergency situation, which effectively means that the emergency push which the policymakers provided to offset the fallout, visa wider fiscal deficits, very loose monetary policy, has to be curtailed or has to be withdrawn at a gradual pace. I'll draw parallels to a steroid. If there is a health emergency, you have to administer steroid, but you cannot do it on a longer term basis because the side effects can be much worse than the shorter term positive effects. In that context, we need to remember that over next few years, we will see the ultra loose monetary policy and ultra loose fiscal policy turning more, turning back towards a pre-pandemic level. This is necessary if the macro imbalances in future have to be contained. So this policy normalization theme across the world, including India, needs to be seen in the backdrop of higher inflationary pressures too. Commodity prices are very elevated. I'm sure in businesses, or you all are exposed to higher commodity prices. You look at oil, crude oil prices. It was trading, at $30 in 2020, and now it's trading close to $90. There are a few forecasts on the street which, where they are forecasting that it might just go to $100. We don't belong to that camp. We don't think oil prices are headed and are likely to stay at $100. We don't expect that. But it's a given that commodity prices over next 12 months are likely to stay elevated. $75 is a given if you're talking about crude oil prices over next 12 months. And that's pretty elevated number, especially when you compare it to even 2019, that is the pre-pandemic phase. Base metal prices, which is an important input, their prices have gone up. And given the supply chain disruptions, they are unlikely to come down, which effectively means that if you are in the policymaker's place, besides growth, you will also have to take into consideration the inflationary impacts. If inflation is left unanchored, it will impinge on growth over a medium term. And that is the reason why we think most of the central banks, including in India, will have to start normalizing monetary policy or raise rates. So this is the broader backdrop which I wanted to highlight before we start assessing the implications of union budget on India in specific. To start off with, of course, we all focus on the budget to understand its implication on economic activity. And as Dr. Vijay very rightly highlighted, there were not too many new stimulus measures, or not too many measures to boost consumption or to provide an extra push to the overall economic activity. And I completely agree with him on that. Having said that, the backdrop which I painted, I think that also needs to be kept in mind. Before the pandemic, the central government was running a fiscal deficit of 3.5%. In the current financial year, they are likely to end up with a fiscal deficit of double the size, close to 7%. And next, they are trying to take it back towards 6.5%. It is not as large as the market expected, but it is still double the size of what it was in the pre-pandemic phase. The other good part about the budget is the consistency. Since last year, we have clearly seen a shift away from transfer of purchasing power towards capital expenditure. It's not that the vulnerable section has not been kept in mind. In FY20, in FY21, in FY22, whenever there has been a need, right amount, or say, whatever amount of support was needed for the vulnerable section in terms of food grain distribution, etc., was provided to them. But as we exit those emergency situations, they are now pivoting more towards capex, because capex related expenditure, while its short-term effect is limited, over a 3 to 5 years period, it can have a multiplier impact of as large as 3x. So for every 1 rupee, the impact on GDP can be 3. And that is where the government has shifted its focus on. From a growth forecast perspective, we are looking at an 8% GDP growth forecast for next year. We have not changed our numbers post the budget because there is a capex push. The fiscal deficit was wider than expected. But probably if we have to assess the impact on growth, we need to wait for the budgets of state governments. For every 1 rupee spent by the government in India, almost 60 paisa, 55 to 60 paisa comes from the state governments. So solely looking at the union budget will not give us a good picture on how the capex push and how the expenditure push from the government is going on. We need to wait till mid of 2022 to get a clearer sense on it. And that's why we have retained our 8% forecast. There was a 1 trillion rupee of loan given to states, a 50-year loan at 0% interest rate. That is good because states are closer to the projects and they can implement far more efficiently than the central government. But we have to see state government's budget, especially as their revenue stream from the GST cess, the assured GST cess revenue stream would stop next year. So it's, in our view, it's neutral to slightly positive from the growth perspective. And as I said, central government budget is important, but we need to keep a close eye on state budgets too, to understand the full implications on economic activity. Since we think it is neutral to slightly positive on growth, what does it mean for inflation and interest rate? We do not see this budget as inflationary because the focus is on capex and not transfer of purchasing power. In fact, we were slightly disappointed as the employment guarantee scheme allocations were not high. They were on the lower end. So there's no transfer of purchasing power to say so, and therefore it shouldn't be too inflationary. Having said that, the realities which exist for the world at large exist for India too. Inflation is a concern for India too, especially with oil at $90. We import 80% of our oil requirement. And this effectively means that policy rates have to go up. If you have an interest rate exposure, then you have to ready yourself for higher interest rates over the next 12 months. In terms of repo rate, that is the RBI's policy rate, we expect 75 basis points increase. Currently, it is at 4. We expect it at 4.75% by end of this calendar year, 2022 calendar year, it will be at 4.75. If you are exposed to market rates, for instance, bond yields, probably you need to brace yourself for a sharper increase in interest rate because bond market, besides inflation growth dynamics, are also driven by fiscal deficit. And fiscal deficit, as I mentioned, was much larger than expected. And as a result, the government will have to issue many more bonds than what the market was expecting, and that will push yields higher. We were, 6 months back trading. If I take the 10-year, we were trading closer to 6.10, 6/4. We think we are now trading closer to 6.80 in terms of bond yield, and our view is in a matter of 2 to 3 months, 10-year bond yield will trade closer to 7.2%. That's a very sharp increase. So if you are exposed to market rates, given the large fiscal deficit, given the inflationary pressures and policy normalization, I think one has to brace for higher interest rates. But let me assure you that these rates are not going back to the pre-pandemic level. As I mentioned, the policymakers are aware that there is a permanent loss, a deadweight loss due to the pandemic. And in the near term, there can be an upside pressure, but eventually we are still likely to end up at rates which are lower than the pre-pandemic level. I mean, for instance, the repo rate, which I was quoting, during or till 2019 was at 5.15%. We don't think in this cycle it will go anywhere above 4.7%. Last but not the least, what happens to the INR? I mean, we saw a massive move in Indian rupee yesterday. It weakened. What happens to the Indian rupee post the budget? Our view is that, and again, I mean, I don't think the budget really changed our view. In fact, with the budget presentation, our view of a weaker rupee was further reinforced in a much more stronger fashion. We have a forecast of rupee trading at 75.50 by March end, March of 2022, and 77.50 by end of December 2022. And this probably is likely to come because with oil at $90, even if it comes down to $75, the trade deficit would remain pretty large. India runs a current account deficit. And as we move to 2% of GDP, kind of a current account deficit metric, we can see rupee weakening. The other bigger issue is about exports. Exports have done exceedingly well for India over the last 12 months. But we expect global growth to slow in H2. I would say moderate, not slow, in H2. And that effectively means that after achieving the 400 billion target this year in exports, probably we are not likely to see a similar, a repeat stellar performance next year. So there can be some moderation in exports, and that effectively, again, will keep rupee on a weaker footing. And last but not the least, I think one of the biggest asks from yesterday's budget was some tax changes which could have paved the way for Indian government bonds inclusion in one of the major global bond indices. That didn't come through. And the commentary from various officials highlight that it's not going to come over next 12 months. If that tax change would have happened, India could have got $20 to $40 billion of inflows. And that won't happen, which effectively again means that the flow story, the dollar flow story, will not be supportive of Indian rupee. And hence, we expect rupee to remain on a weak footing and weaken as the year progresses. 75.50 by March and 77.50 by December 2022. So I'll take a pause here and hand it back to Dr. Vijay. Thank you.
Thank you very much, Ms. Sahay, for sharing your views on the impact of union budget on interest rates, on currency, and how exporters and importers should manage their currency risk, and your call on interest rate as well. May I now invite Mr. Firoze B. Andhyarujina to share his views on the impact of union budget on direct taxation.
Yes, Mr. Chairman, this union budget is, according to me, a very complicated budget. It has tinkered a lot and has tried to plug all loopholes or little bit benefits given to the taxpayer, and which the taxpayer had done some kind of tax planning. There are in all about 85 amendments, 10 insertions, 1 substitution, and 1 retrospective amendment. So all this goes on, and therefore, according to me, the finance minister, while presenting the budget, gave a very simple analysis. But if you go to the finance bill, there is a lot of complications which are involved. Let me come straight away to some of the provisions which are important. The first provision is what the finance minister said is upgrading your returns, called upgraded returns. Appeared to be very simple, but if you look into the details of the upgraded return in section 139, subsection 8, a new section which is introduced, 8A. This upgraded return means if you take the present current financial year, individuals were supposed to file the return by 31st of July. If you missed the deadline, it would be now 31st of December. If you have still missed, then the finance minister says that there is a chance for another 24 months, 2 years to upgrade and come out cleanly, that if you have missed something or if some information is not there, it should be a complete return, upgraded and finalized. However, the catch and the issues are the following. Number one, for 2 years period, you can revise it, subject to that in the first year, the first 12 months, you have to pay additional tax of 25%. In the next 24 months, you have to pay additional tax of 50%. According to me, there will be very few takers, because in such circumstances, as the law stands as today, what can be done is you can write to the assessing officer saying that we are a law-abiding citizen complying with the law. I want to recompute my income, give a revised computation to bring it in accordance with law, and I want to pay the taxes. And you can even tell him, you reopen my return under 148 and take the point. Now, paying such an additional amount of 50% for 2 years after a period of 12 months, according to me, there will be very few takers. Secondly, look at the catch. You can file an upgraded return only for claiming and paying additional tax. The law says that it should be a complete comprehensive return bringing in all the points. Please note one important point in computing that if you find that you are entitled to a refund, or if you find that you are entitled to a higher loss, you can't go under this section, because the section specifically bars that this section is only for the payment of additional tax. You can't go for refund. To bring in a correct picture, you find out, your chartered accountant informs you that what is required is that we have made some calculation mistake, or a claiming of a deduction is to be done at a higher rate. So therefore there is refund. You can't get the refund at all. Additional taxes to be paid, no refund, no loss, no claiming of exemption. Take the third issue. If there is a notice of assessment issued under 143.1 or 143.2, starting the proceedings, then you can't proceed in this year, because it says that pending proceedings, including the issue of notice, is not allowed. Take the fourth issue. This law will not apply if you have received any prosecution notice or any proceedings under the Smugglers Act, Binami Act, or any other FEMA, FERA, etc., you cannot proceed if there is some allied proceedings. Take the next issue. In these circumstances, is it possible for any person to make such additional payment and go in for upgrading the return? It would be only beneficial for those people who had concealed. So in other words, I am looking at section 139(8)(a) as one kind of an amnesty scheme voluntarily brought out by paying of additional tax in the first year at 25%, in the second year at 50%. Take the second issue. Bonus stripping. There was dividend stripping which was removed. However, there was bonus stripping which was available to the assessee for valid tax planning. Let me give you an instance. You sold an immobile property for which you got 10 crores of rupees. The cost of that is 5 crores. Along with indexation, it is 6. So there is a capital gains of 4 crores. So you ask the tax advisor, how do I reduce the tax on my capital gains? So the answer was, you buy a share which is pregnant with bonus. Supposing you buy a share which is pregnant with 1-to-1 bonus. So what happens? Supposing the value of the share is 1,000. So after 1-to-1 bonus, the price of the share would be 500 approximately. What you do, you take the original share, 1,000 rupees, which is your purchasing price, minus now the value of 500. 500 is a loss. The bonus shares remained as it is. You sold it, so there is 500 rupees loss, which you could offset it against long-term capital gains. This has been plumbed, this has been removed, and with the result that now bonus stripping is not available, they have added the words shares, securities, even rights, some any other security which are covered. So therefore this bonus stripping issue is gone. Take another case. A proviso has been added to section 68 on cash credits. On the question of cash credits, we were concerned with share capital and share premium. Now the law extends it for loans, for borrowings, and even for debentures. These are also covered, and what is required is 2 criteria. They have said that department can go into the source of source. There are a number of judgments starting, including of the Supreme Court, in Rohini Builders, that you can look into the source, but not into the source of source. This goes into the source of source issue, and the onus is on the assessee. Take another case, and that is amendment and bringing in a new explanation to the already explanation in section 37(1). Section 37(1) deals with deductions. To this deduction, they have introduced one additional point in the explanation that you are not entitled to claim an exemption or a deduction under section 37 if you have made any payment which is illegal or prohibited by law or forbidden by law. Now, in this connection, they have also added one explanation B, which says about perquisites and benefits received by any person for which the other person has claimed a deduction. So you would say, what is the benefit and perquisite? The answer to that, if you look into, is to hit all medical companies and pharmaceutical sector and doctors. You see, what happened was that there is a decision of the Ahmedabad tribunal which started this whole controversy. The controversy was this way, that the company gave gifts, traveling expenses, demonstrations, conferences, lunches, dinner, etc. to doctors to promote their medicine. One assessing officer came out with the idea that this is not correct, this is prohibited by the Indian Medical Council by its Act of 2005. Therefore, it is an activity prohibited by law. The matter went up to the tribunal. The tribunal came to the conclusion that the definition of illegal activity, etc., and prohibition applies to individual doctors. It does not apply to a pharmaceutical company per se. And therefore, the deduction was allowed, though this was a case of reopening of assessment. The matter was carried to the High Court, but in the meantime, there were decisions of the Gujarat High Court, there was decision of the Delhi High Court, there was decision of the Bombay High Court, and then the Gujarat High Court, in a very comprehensive judgment under the reopening question of 147, 148, came to a correct conclusion that such kind of amounts given to doctors or conferences or gifts or to promote their medicine and claimed under the head sales promotion expenses cannot be an item prohibited by law. To overcome that judgment, they have brought in now this amendment saying that any amount given by way of a perquisite benefit or advantage to any person by a company would be definitely hit, and therefore such an expenditure would not be allowed. Along with that, there is one more point. It is mentioned in that section in sub-explanation C that compounding expenses would not be allowed as a deduction. Now, I see no need why compounding expenditure is brought under the head of illegal expenditure. First of all, wrong placement. Secondly, you apply for compounding. Why? Because you want to buy peace. You said there is something wrong. I don't want to go ahead in litigation. I'm ready to go ahead with compounding. There are series of judgments, including of the Supreme Court and of the Privy Council, that if at any point of time a person has to defend his title, defend his reputation, or defend the purposes of business, that is a business expenditure. But now they say that even compounding expenditure would not be allowed. And for cess, there was a judgment on cess by tribunal and by courts. Let me give you the direct example. The Bombay High Court in Sesa, Goa said that there is a difference between surcharge and cess. The Rajasthan High Court in Chambal Fertilizer also mentioned that there is a big difference between a surcharge and a cess. Cess stands on a different footing, and cess cannot be given a footing of the surcharge, and cess could be allowable. Based on that, number of tribunals were following the judgments and allowing the deduction of education and health cess. Now, they have passed an amendment with retrospective effect, and that too with effect from 1/4/2005, assessment year 5-6 onwards, 17 years old, retrospective amendment to say that such cess, educational cess, will not be allowed as a deduction. And one last point I would like to deal is about the cryptocurrency. So far as the cryptocurrency is concerned, first of all, let me tell you, the notion that cryptocurrency would be banned, the notion that the government would not allow cryptocurrency has now been settled. Cryptocurrency is now a recognized point in India, and the fact that 30% flat rate is charged on transactions shows that government has recognized cryptocurrencies. Number 2 point, you have to pay as capital gains after deducting the costs, no indexation, 30%. Number 3, you cannot be allowed set off, which is very surprising because inter had always profit and loss is allowed. Means, other words, if you have made a profit in Sandbox, if you have made a loss in Mana, you can set it off in cryptocurrency itself. That was a common sense. But they said it is not to be allowed in any set off. Therefore, the proposition which emerges is that cryptocurrency is transaction oriented and it is not a composite income computation. Number 4, if you gift it, there is a tax in the hands of the recipient. Next point, TDS would be attracted at the rate of 1% on all transactions of buying and selling of cryptocurrency. But one thing is now clear, that cryptocurrency is now recognized to give seal of authentication. The government has also said that there will be a direct rupee currency payment, which is very clear that once you have a rupee currency regulated by a direct payment by the laws of the Reserve Bank of India, then it would mean that India will also bring out a cryptocurrency in the near future. One last point is that I want to point out, Finance Minister gave a very small point on direct taxes. Let me tell you that if you go to the finance bill, all kinds of loopholes are plugged. One last point, that when you sell a property, you are required to deduct TDS at 1% and then you make the payment to the buyer. That 1% TDS was normally on the amount of sale consideration. Let me give you one instance. You sold your immovable property for 70 lakhs. The stamp duty valuation is 76 lakhs. Now you pay a stamp duty on 70 lakhs. On 76 lakhs, but TDS 70 lakhs. Now the law also provides that a variation of 10% is allowed. So 70 lakhs up to 77, there is no problem. Now the law says no, you will have to deduct your TDS on the sale of immovable property to the recipient at 1% of the stamp duty consideration and not on the net consideration paid. That's the amendment in section 94I. It is that I think it is required that we focus more on creation of jobs, curtail inflation, and people have been paying honestly their taxes. Therefore, kindly, with the inflationary tendencies, reduce the burden of tax. The tax rates need to be changed and the slabs need to be increased. Thank you.
Thank you very much, Advocate Andhyarujina, for sharing a lucid explanation on various amendments of Finance Bill. I hope this would have been very useful for all the attendees. Now, I request all the participants to share their questions on the chat box. With this, we move to our next speaker, Mr. Niladri Chakrabarti, to share his views on the impact of various provisions of the Finance Bill on India's foreign trade and MSMEs. Mr. Niladri.
Good afternoon, Dr. Kalantri, Mr. Andhyarujina, Ms. Sahay, and the participants. On the indirect tax front, the focus on the budget has mainly been on manufacture and infrastructure growth. If you look at the policy side of the MSME announcement, there has been a lot of emphasis on capital infrastructure inducement and growth of logistic hubs and skill management, access to credit, compliance, ease of doing business. Now, if I may divide the MSME proposals into two parts, one being policy and other being the tax part, and then try to link it with whatever benefits out of foreign trade policy that can come out, or foreign trade or exports that can come out. On the policy sides, the proposals are robust. There is a clear focus on enhancing capacity building. The finance minister has talked of PM Gati Shakti, the 7 engines of development, as she called it, and a lot of investment, infrastructure investment has been given on developing logistics. In addition, to promote the MSME sector, there has been a lot of focus on enhancing the manufacturing capabilities of the sector. There have been the emergency credit scheme has been extended by a year. There has been a RAM program which talks about accelerating MSME performance, and there is, I believe, a 6,000 crore allocation towards this program. And there are other incentives, like giving incentives to startups to register and claim tax incentives. So on the policy side, there seems to be this thrust of infrastructure building, of making good a manufacturing hub, and and a powerful incentives to the sector to come in and grow in the country. Coupled with this is this so-called emphasis on a trust-based compliance system. And this is purportedly for the ease of doing business. Now, while there has been a lot of emphasis on building trust among taxpayers, assessees, and the government, there is, while there has been some development, there is no concrete, practical illustration on the ground that the government is willing to loosen the strings and prefer the taxpayers to operate within their sandbox. And if there is no serious infraction, the ease of doing business compliance can move on. There has, on this trust-based system, the entire import of goods and concessional duty, the entire rules for that have been revamped. It is supposed to be automated now. You can file there will be a single window. You can file your forms, returns electronically, claim your notification benefits electronically, and so on. Now, if you look at the GST side on this trust-based analysis system, the taking of input credit, which was earlier allowed on a provisional basis, has completely been removed now. Now you can only take input credit as will be communicated by the GSTN system on the basis of your supplier return. Now there is where this dichotomy comes, because now the moment you move to a self-assessment system on the basis of something which is supposed to be automated and provided by the portal, and negate taking of provisional credit, there seems to be a feeling that the government wants to get into the ease of doing business, but is very tentative on loosening the compliance, losing the compliance barriers on the taxpayer. And this is worrying, because in the MSME sector, as the law has come from the budget yesterday, today input credit can only be taken on the basis of an automated return, which will be provided by the system. Now, we all know how the system has functioned. The GSTN system has functioned in the last 4 years. In the initial year, there were teething problems. There still are teething problems. It's been uneven. And today, when you remove a two-way communication system and tell the taxpayer that you can only take your credit on the basis of a data which is A, generated by the system, and B, dependent on the supplier on whom you may have little or no control about, that creates a lot of ambiguity in the minds of the taxpayer. On the manufacturing front, in the customs space, the customs duty exemption given to steel scrap, which was given last year, this has been extended for 1 more year. The anti-dumping and countervailing duties on steel products, high-speed steel, cold-rolled steel, which you would import from China, Vietnam, Germany. The countervailing duty and the anti-dumping duty has been removed, which is a good thing. And there has been a very big focus in the customs duty space on removal of exemptions for items and inputs which have been imported from abroad. And this is a primary, and this is the primary objective of this, is to promote the domestic manufacturing entities, to bring domestic manufacturing at par with sectors where there have been a lot of exemptions. A lot of exemptions have been removed. There is a proposal to remove the concessional duties on capital goods, removal of the project import scheme, which would allow, which earlier allowed concessional duties, and bring them at par with domestic industry on a at par 7.5% customs duty rate. So this is all incentives, carrots to make domestic, to bolster domestic manufacturing. The PLI scheme of this government has seen success over the last 2 years. We have had PLI schemes last year on semiconductors, on biotechnology, on medicines, manufacturing, textiles, etc. Now we have 2 more PLI schemes. Solar PV modules. There has been a 4,500 crore PLI scheme introduced for solar PV modules, and going forward, manufacturing of 5G telecom equipment and research and development into that scheme, separate PLI scheme has been proposed. So these are the emerging sectors in which the government wants to get in, wants domestic manufacturing to flourish. But it seems that like they're tentative on removing the compliance reins on the industry. The other key customs impact is there has been a lot of customs duty decrease on camera lenses, on modules used to make mobile chargers. All these give fillip to the domestic industry. There has been a considerable decrease in the BCD rates, which on textiles and chemicals. And one very important aspect of this is that earlier these exemptions to BCD inputs for BCD rates were given to notification. Now they are being directly moved into the customs tariff, so that the compliance is better. The finance minister yesterday said that there will be more customs duty exemptions on the textile sector for inputs made by the textile sector, leather, food packing. And she also mentioned that customs duty exemptions on capital goods on these sectors like textiles, leather, food packing would also be removed. Again, all of these steps are thrust to the domestic manufacturing industry. The other very important development on the customs front was the phased manufacturing program. This has been introduced for 3 components, which are wearable devices, essentially wearable devices, smartwatches, hearable devices, which are speakers, Bluetooth speakers, and we have seen a lot of made in India products, especially in the hearable devices front over the last 1.5 years, and smart meters, which is now the trend which is now gradually coming into the domestic sector. So a phased manufacturing program has been introduced. Now, what the phased manufacturing program will do is, over the course of the years 22 to 26, it will, to help the domestic industry, the domestic manufacturing industry, and there is a lot of potential in this industry, increase the customs duty on inputs at a staggered level. From year 22, it will be increased to 2.5% to about year 26, where some components, if reported, would hit the duty about 20%. Now, this is a very welcome initiative because the hearable sector has been seeing a lot of very interesting growth, and the products that have been coming out in the sector are almost at par with some of the global brands. So this is going to be a big fillip to this industry. If I move on to goods and service tax, again, on the compliance side, the removal of provisional credits seems to be a very tentative step because for whatever reason, and this is actually a big disadvantage to the industry because now you are at the mercy of an automated portal, and even more, you are at the mercy of your supplier. So an industry would have to keep very close tabs on its suppliers to make sure that their returns are filed correctly, because it is on the basis of their returns that they would be now allowed the input credit. And this is a very onerous and a very tedious obligation given to the industries, the MSME industry. While there have been two advantages legislation that has been introduced. One is cash balances have been allowed to be transferred from GSTN to GSTN of the same PAN, which basically means that you have two companies, GSTN, which have the same PAN, and one is cash rich. It can now transfer its cash balance to the other GSTN. So this would help units which have sectors, manufacturing units which have two or more factories to balance out their cash structures, their cash credit structures. That trust come down to the promotion of exports and what impact does it have on foreign trade. One very big change, as we all know, is that the SEZ Act is now proposed to be abolished, and there is going to be a new regulation which will bring in more state stakeholding. Now, this is very important because the SEZ Act in its present form put a lot of onerous compliance on SEZ units. Now, the expectation from the new regulation is that some of these compliances will be removed, and the units in the SEZ would be at par with domestic, non-SEZ units. And as Madam Sahay had said earlier, that the states, there is a lot of impetus and there is a lot of responsibility on the state, and the states are the actual keepers on the ground to, increase and regulate and trade. So the more stakeholding that comes in, and one of the objectives of the new SEZ law, which is proposed to be coming out, is that the states would get a lot more say in the regulation and compliance. And this is a welcome move because at the ground level, it is the state authorities, the state GST authorities, who are actually doing the actual on-ground compliance, and they are more attuned, they're more fine-tuned to the regulations prevailing there. Another very big incentive and another very big change has been the complete abolition, the complete revamp of the IGCR rules. Now, the IGCR rules provide that you can import inputs for domestic manufacture on duty-free, provided that you export it back within a certain amount of time. This amount of time has now been fixed at 6 months. There has been a duty-free import concession given to handicrafts, apparel, leather goods. And this is very important because these are sectors, especially the leather goods sector and the handicraft, which have been affected by the pandemic. So given this duty-free import, this would bolster their exports and help them to reach a market level. Another very important stipulation has been that exemption notifications, which are part of free trade agreements, for example, the ASEAN agreement, which proposes nil BCD or concessional BCD, these will not be sunset when exemption notifications on customs duty eventually sunset out in the course of the year. And this is very important because as we know that India is now on the verge of negotiating another set of free trade agreements with the UK, with the EU, and a lot of the groundwork or a lot of the structuring of FTAs are on reciprocal customs exemptions given to each other. So this is very important that the exemptions given by FTAs, by ITAs, international trade agreements, are kept in sync. Maybe some of them could be relooked at, but on the whole, this is a very positive development that the exemptions are not sought to be phased up. There has been a lot of speech, a lot of points on how to automate the industry for the ease of doing compliance, to facilitate ease of doing business. The finance minister talked about setting up an e-commerce portal for jewelry exports. Regulations are expected around June, July this year. There will be live organic databases which will give information on B2C, B2B businesses, G2C businesses. The entire compliance system of the import rules, of the imports, duty-free imports, duty-exempted imports, are now sought to be made online. And we have a feeling that the new SEZ rules would also be, and because there is already a single window process established, would also be completely automated. So on the whole, the indirect tax side of the budget has been very growth oriented. There has been a lot of emphasis on capacity building, on infrastructure building, on skill building, and an idea that if compliances are loosened, if the strictness of compliances are loosened, the industry may become more robust. Because at the end of the day, when you have 148 crore of GST collection in the year, which is the highest in the last 4 years, the industry has contributed, and for that they deserve to be rewarded. And the MSME sector is one of the biggest contributors to this growth. So yes, a very growth-oriented budget, a very IT prospective budget, a budget which looks at the industry and tries to promote the manufacturing growth of the country. But again, there are niggling problems. There are niggling ideas which kind of stutter this growth perspective, and these need to be looked at. But overall, a positive and a growth-oriented budget, at least on the compliance, at least on the manufacturing incentives side. Thank you.
Thank you very much, Mr. Niladri Chakrabarti, for highlighting some of the customs notifications in the finance bill and how it would impact India's Make in India program, indigenous manufacturing, imports, and specifically how the government's proposed SEZ regulations that's going to pan out. And as you highlighted, flagged the issue of ITC provisional refund, how that amendment is may put some of the buyers on the spotlight. Of course, we are getting some queries from participants as to what would happen if there is a cancellation of GST registration if return is not filed for or within prescribed period by the seller, or if your vendor's GST registration is cancelled due to non-compliance. The same could impact the ITC claim of the buyer. So these are some of the legitimate concerns being raised by the trade and industry. And of course, some of the participants are asking what are the sectors they need to focus for export opportunities, given the slew of customs duty changes, and thirdly, some participants are asking, now the government has increased, has removed the exemption on capital goods input for some of the capital goods. So would it affect our Make in India program, given that we are reliant on import of capital goods in some sectors? So these are some of the three broad questions. Of course, once these questions are answered, we have one or two questions for Ms. Anubhuti Sahay. So you can briefly answer those questions.
Yeah, I will take them one by one. I believe the first question was, if the ITC of the supplier is cancelled, what happens to the ITC? Will the ITC get clogged? Will you, as the service or the supply recipient, face a problem? Now, it's a very legitimate question because now you can only get the ITC which the supplier has declared in his returns. And the earlier two-way communication system of returns has been abolished. Provisional credit taking has also been abolished. So now, as I said, you as a supply recipient, there is a more responsibility and more onerous responsibility on top of your other responsibilities to make sure that your supplier is above board and his returns are filed above board. Because if there is a default in those returns, you don't get the credit, and that's it. And your credit is now going to be governed by an automated GST statement from the portal. And as I said, the functioning of the portal, and in fact, it's been called up. The high courts in Delhi have been very critical on the functioning of the portal. So we feel this provision is actually a thorn in the entire process in the ITC system, and maybe there could be a relook at this. A discussion could be had around this, but this we feel is going to create more problems to the already faltering sector, because there is anyways a lot of ITC litigation in the courts, and when you remove e-prospective or provisional credit and make it entirely dependent on a third party, there is bound to be we foresee some problems in the system. So yes, it is. I completely agree that this could be a point of concern. I believe the second question was on sectors to focus on now that the manufacturing, there has been a lot of stops for manufacturing. Well, there has been a lot of PLI schemes that have been introduced, textiles, handicrafts. There has been a lot of PLI schemes on electronics manufacturing. So, and consequent customs duty reductions on customs duty rationalization and reduction. This is rationalization to promote the manufacturing sector. So again, the government seems to be identifying these key 2, 3, 4 sectors which are doing well and which is a lot of potential in the global market, if I may call it, and giving incentive to them through the PLI schemes. So that is a very welcome step, and there has been a lot of investment in the PLI schemes. There are allocations to starting for 4,500 crores to about 12,000 crores in some sectors. So yeah, it is a great opportunity to showcase domestic manufacturing. The other question, I believe, was on removal of concession duties on capital goods. The government has said that this is to give level playing ground to domestic manufacturer, but there is also a rider which says that goods which cannot be manufactured in India, or for goods or for capital goods, for example, which are not available in India, there will not be a cut. There has been a statement in the finance minister's speech yesterday. If I can give you an example, in the plastics industry, almost the entire capex has to be imported because these are huge machines, and these are machines which are like 2-3 stories tall and which are completely manufactured outside by 2-3 specialized companies. So machines like that, which can only be globally, the concessional duty on capital goods will still remain, and it would not be grandfathered into the 7.5% scheme they're talking about. Is that all the question? I see a question on GST 18% on transfer of cryptocurrency. The finance minister and the finance bill do not talk about GST on cryptocurrencies. That is a slightly ambiguous site in the indirect tax legislation. Though what are digital assets, that has been clarified, but there has not been any specific clarification on what the GST rate would be or how it would be governed. There was a proposal from the TRU committee that they be classified as OIDAR services, but there has not been any clarity as such from the finance minister or the budget on the taxation. So yes, that is an ambiguous step. Is there any other question?
Thank you very much, Mr. Niladri, for clarifying these questions.
Thank you.
We have one question for Ms. Anubhuti Sahay. One of the participants is asking, as you mentioned, you expect RBI to hike interest rate by 75 basis points in the calendar year 2022. So what would happen to the borrowing cost of MSMEs? Do you expect in the forthcoming RBI's credit policy, RBI should give any concessional, any refinance window or some interest rate support to MSME sector, especially the COVID hit sectors like hospitality, tourism, entertainment, etc.?
Thanks for the question. I think if you're talking about the general interest rate, and if one is accessing funds either from the bank or from the markets, interest rates are clearly headed higher. However, for MSME, this whole scheme, the emergency credit line guarantee scheme, is one area where not only 1 year extension has been given, but also the total cap has been increased from 4.5 trillion to 5 lakh, 5 trillion or 5 lakh crores. So I think that is an area where they can get some relief on providing some kind of an interest benefit to MSME. Probably that's an area where both the government and the RBI can work together, because that is one segment which will need continued support, even though for the economy at large, some bit of a policy normalization will happen during 2022.
Thank you very much, Ms. Sahay. Now, all the questions are over. Now, Mr. Andhyarujina had to leave the session because he had some other commitments. Now, may I request Dr. Vijay Kalantri to propose vote of thanks and conclude the event. Dr. Vijay Kalantri.
Thank you very much. Of course, Firoze in absentia and Madam Anubhuti Sahay, Mr. Chakravarti. I think we have got an overview of the budget, and I hope you are able to hear me.
Yeah.
We've got an overview of the budget, but as some of the issues raised by you, at one stage we say it's a good budget, second stage we say no, nothing is going wrong, but some fine print yet needs to be studied and looked at very seriously. Because till then we do not know what is in the fine print. It's difficult to praise something which overall looks good, but not otherwise may sound that well. Because I remember Chidambaram's dream budget, and the dream budget, first day the market went up by 1,000 points and next day it went flat by 2,000 points. But this market has still behaved well today. But Mr. Firoze Andhyarujina raised some issues on retrospective tax and so many provisions and amendments, and like in GST also. So if one thing is very serious, that if the vendor or somebody's number is cancelled, the other fellow cannot avail the credit. For MSME, it should be a very difficult thing. But interest is bound to go up because our borrowing is going to be up and money will be under pressure, finance will be under pressure, and also the FIIs and FDIs may also not like to invest here in India because the interest rates in US is going up. And that's one of the reasons where finance scarcity may be there to see. Let's see how we tackle that. Although FIs are withdrawing, still the market has done well. But let's see in the long run what happens. We keep our finger crossed and hope for the best. And we look forward to a better growth and better economy and better employment. Thank you.
With this, we come to the end of this special webinar on implications of Union Budget 2022-23. Thank you very much to all the participants and distinguished speakers.